Debt Market Update, May 2020. The yield on 10-year G-Sec ended the month of May 2020 at 6.01%, down 10 basis points over the previous month end. Average net interbank liquidity surplus increased for the month due to high government spending, soft credit growth, vis-a-vis deposit growth, purchases of government securities, and foreign exchange by RBI. 10-year AAA corporate credit spreads over G-Sec reduced by approximately 16 basis points during the month. In an unscheduled meeting during the month, Monetary Policy Committee announced reduction in repo and reverse repo rate by 40 basis points each to 4% and 3.35% respectively, while maintaining the accommodative stance. RBI also announced the following key measures. Permitted lending institutions like banks, NBFCs, HFCs, MFIs, etc. to provide a moratorium of another 3 months on installments of term loans and payment of interest on working capital loans. Interest accumulated over deferred period can be converted into funded interest term loan repayable by end March 2021. Extended INR 15,000 crores credit line to Exim Bank for a period of 90 days with a rollover up to a maximum period of 1 year so as to enable it to avail a US dollar swap facility. The measures announced were mainly targeted towards improving liquidity and easing repayment pressure of borrowers. For more details on RBI measures and its impact, please refer our commentary dated 22nd May 2020 published on www.hdfcfund.com. In other developments, the central government raised its targeted gross market borrowing by INR 4.2 lakh crore to INR 12 lakh crore for FY21 to cover the expected shortfall in revenues and to fund the proposed stimulus. However, yields remained soft on back of high system liquidity, weak credit growth, and expectations of interventions by RBI. Outlook. The RBI's decision to reduce policy repo rate by 40 basis points during the month was largely in line with market expectations. Over the past few months, RBI has conducted Operation Twist, LTROs, TLTROs, open market purchases, etc. These actions, along with RBI Governor's statement about benign inflation and challenging growth outlook, indicates that RBI is open to take further conventional and unconventional policy measures to counter the impact on slowdown due to the pandemic. Further, weak oil prices, positive outlook on balance of payment, benign inflation outlook, low global rates, and easing liquidity by major central banks bodes well for yields in India, and there is some room for yields to decline in our opinion. However, overhang of large supply of government securities, especially at the longer end, excess statutory liquidity ratio investments within the banking system, any sharp reversal in oil prices, high near-term inflation, etc. are key risks to our view. In view of the above, yields at the longer end of the curve are likely to trade within a range in the foreseeable future. Considering the aforesaid factors, we maintain our view that the short to medium end of the yield curve offers better risk-adjusted returns. Thus, we continue to recommend investment in short to medium duration debt funds. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.